Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So from time to time, I see this comment, I get this question, can I do velocity banking, or how does velocity banking work if I get a weekly or biweekly paycheck? And to be honest, most people get paid like twice a month, right? So whether you get paid twice a month or biweekly or every 2 weeks or every week, right? Velocity banking is the same, right? Because the requirements are just two things, and it's going to be stay the same regardless if you get paid um, biweekly, weekly, once a month, right? As long as you're able to satisfy the payment of the line of credit, which is going to be on a monthly cadence, you only need two things. Okay. So the first thing is the budget, and the second thing is the line of credit as an operating account. Now, if you have no idea what velocity banking is, let me say this first. Go ahead and click the link to Velocity Banking 101 down below and then come back to this video. Now, here's the thing. In this video, I've already done the budget for you, right? So income, expenses, leftover checking savings, and this is just an expense breakdown. Now, the whole point of the expense breakdown is that you're going to list every single debt you have as well as some general expenses. And our goal is to get rid of this debt to increase our cash flow. And then we're going to use our line of credit as our main operating account, right? So the difference between the average American and the velocity banker or banking person is that what's our main operating account? Is it our checking and savings? Are we paying our bills out of our checking savings? Or are we using our line of credit? Right? And there's various types of lines of credit. There's home equity, there's personal, there's business, there's credit cards, right? Credit cards are a form of line of credit, but they have some restrictions. So, for example, I can't pay credit card one with credit card two, and vice versa. I can't pay a loan with a credit card, right? So, you always want as much credit as you can get as possible before you ever need it, because there's a saying that banks only lend money when you don't need it, and have a combination of both, right? I have $220,000 in lines of credit, most of it in credit cards. I have a $50,000 home equity line of credit and $15,000 personal line of credit, right? So now, just to do a quick demo of how velocity banking works, whether you're paid biweekly, you know, weekly, whatever, right? So let's just go ahead and do this. What we're going to do is rearrange our expenses so we can increase our cash flow. And then the strategy is you're going to put your entire paycheck into this line of credit, right? So line of credit is just very similar to a credit card, except that you click a button on the bank's website and cash is dumped in your checking account, okay? And then you take out your expenses from that line of credit and then you watch it go down based on your cash flow. Okay, so now we have our income, and then let's do this. Let's refactor our expenses, and this checking savings is always going to go to zero with Velocity Banking because if we need money, we just pull it from our credit line. And then what's our cash flow, right? So our cash flow is going to be based on our expenses, but here's the cool thing, right? Let's say I move this credit card to this line of credit, the entire balance, right? Let's move the whole 10,000. Then what happens? This is satisfied, right? So now this goes to zero. And let's go ahead and sum this up. The expenses equals sum B8 to B11, okay? And what's our cash flow? It's just this minus this, so equals C2 minus C3, okay? So this is our cash flow, right? Well, actually, did I do this wrong? C2 minus C3? Yes, I did, because yes. Okay. It's not B8 to B11. It's C8 to C11. My bad. All right. So now we've increased our cash flow by simply transferring this debt to this line of credit. And what we're going to do is here's the thing. Now, let's say this is month zero and then month one, right? When we put our entire paycheck, right, it doesn't have to be all at once. So let's say equals $10,000. Actually, let's see what happens. Let's say this is we get paid weekly, right? So 5,000 divided by 4, 1250 a week. Okay. So what we're going to do in the first month is, well, this is month zero. So during the process of month zero, what we're going to do is as soon as we get paid that 1250, we're going to do this $10,000 minus 1250, right? That's the first week. And then the second week, we're going to get paid 1250 again, right? And then we're going to dump our entire paycheck, 1250, and then another 1250. Okay, so now the balance will have gone down by 5,000. Now, eventually, the expenses are going to creep up at a certain point in time, although you don't know when. So eventually, the expenses will be 3,487, right? But it's still the same as our cash flow. So it's pretty much exactly the same. Now, the only difference between being paid weekly or biweekly or whatever is it's only going to affect our average daily balance, right? Because we certainly cannot calculate that to a T because we can't predict the future, right? But one of the things that we can do is we can just take the average of these two, right? Take the average of these two and then use that as the average of the daily balance, right? So just take the midpoint. And there's a function in Excel to do that. And I always do that regardless of whether we're paying biweekly, weekly, monthly. This is just an estimate, right? But whatever this average is going to be affected by you dumping your paycheck at certain moments of and whenever you take out your expenses, okay? So don't worry too much. It will affect the average daily balance, but the calculations for the most part are going to be very similar. All right, so let's calculate the amount of interest that you get paid. Again, so it's the average daily balance times the interest rate, so 0.15. And if you see that the interest rate is right here, 0.15 divided by 12, because then we get the monthly interest. And if you don't know anything about how interest rates are quoted, this is annual, and we need the monthly interest. Okay, and then all we do, okay, is just essentially rinse and repeat, right? So it's instead of one big chunk of 5,000, it's minus 1250, minus 1250, minus 1250, minus 1250, and then whenever you're going to calculate get your expenses, it's technically not going to be $304,487 at once, but again, at a certain period of time, you're eventually going to use that money and then have to pay that interest with that average daily balance that I just talked about. So what's the only difference between getting paid with the different pay periods? The average daily balance. And so this might be affected, but it's not going to be greatly affected, right? So let's go ahead and all we have to do is just rinse and repeat, right? So let me actually just do this with the formula so that we can make it easier on ourselves. So it's uh, the previous month's balance, so I2 plus the interest of the last month, J2. At month zero, it's obviously going to be zero because we haven't gone through the first statement period, minus our cash flow, 1512, right? That's our cash flow. Okay. And then now we just rinse and repeat. That's literally all we do. You just rinse and repeat, rinse and repeat, rinse and repeat, rinse and repeat, rinse and repeat. And then I guess we could just wait till this goes to zero, right? Or I mean a negative number, because that means that this is when um, the credit card, or I'm sorry, the line of credit will have been paid in full. Now, one of the things that we can do is take a look at this, right? So at $15,000 at 27%, when we first started this was $487.50. Okay. Now we don't know how much we paid off unless we actually go into a calculator for that, and you can use like bankrate.com to figure out, okay, after 7 payments, what's the actual balance of this and what's the payment amount. Now let's go ahead and check. We can just do a quick check right now. So we'll just do Bankrate minimum credit card calculator. Okay, and then we're going to go ahead and put in that info. So we'll just say 15,000, 15,000. I think it was 27%, if I'm not mistaken. It's 27. And let's go ahead and calculate that. So now what we're going to do is check the payment schedule, okay? And we have to check after 7 payments. So 1, 2, 3, 4, 5, 6, 7. We're at 13,980. That's our balance right now, 13,980, okay? Oopsie, let me go ahead and do that. So that's our current balance. So we paid about 1 grand, which is, I guess, not bad, but most of our payment went to interest, right? And again, the payment is going to differ. It's going to slightly differ, and you could kind of see this, that it kind of goes down, 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 unlike an amortized loan where it's a fixed payment throughout the life of the loan, right? So again, what we can do here now is we could probably move this $3,900 dollars and into the line of credit. So let's go ahead and do that. And then this should be about 10,000. So I'm going to go ahead and add. And let me go, yeah, that's a good idea. Let me go ahead and bold this so I know when the credit or when I moved a portion of the credit card to the line of credit. So it's 3980.97. Okay. And now, what's our cash flow right now? So if we do $10,000 at so let's just do this 10,000 because we calculate now our minimum payment is 325, right? So 325. So this is now $10,000 balance. Okay. So we got that covered. And now what we do is just essentially do the same thing. Well, let me copy and paste, but we just have to modify this a little bit and put our new cash flow in here, which is 1675, right? And then let's just drive this sucker down to zero, just a couple more months. And then now we're again at that negative. And so how many more payments? This was month 8, month 9. So after 2 more payments, we're at the negative, right? So let's just go here. So 1, 2. So now we're at $9,801. Okay. Right. So now this is what we're going to do. We're going to move this $9,801 to this line of credit. And then guess what? We free up this $325 of cash flow, right? So again, exact same process, whether you get paid weekly, bi-weekly, it's all the same because the requirements are the budget and the line of credit. Now, if you get paid, once every 3 months, that's a different story because if you dump your entire paycheck for that 3 months into that line of credit, um, actually, it still might work, right? Because you know what? The beauty of the line of credit is that you can actually pull out money to pay the line of credit. So if I owe $100, I'm sorry, if I borrow $100 from the line of credit, and then the minimum payment of the line of credit is $10, I can actually borrow it from the line of credit. I call it robbing Peter to pay Peter, right? So balance transfer is essentially robbing Peter to pay Paul, but lines of credits are robbing Peter to pay Peter. So even if you're getting paid every 3 months, just dump your entire paycheck into that line of credit, right? How easy is that? Oh my goodness. Now that I thought about that, I was thinking like, yeah, you can't do it like if you're paid every 3 months, but I was like, no, wait, you can because you just borrow the money from the line of credit, right? All right, so now we got that, and let's put our new cash flow in, which is 1675. Yeah, so I got distracted there. All right, actually, ooh, no, yeah, I did get distracted there. Okay, so plus 9801, right? Okay, and then our new cash flow, this is going to be zero, is going to be $2,000. Oh my gosh, how easy was that? So now what we have to do is, and let me bold this because this is when I put the new money in there or transferred. So every time I'm making a transfer, I want to bold it so I know that I moved something to the line of credit. Okay, so now let's go ahead and subtract our new cash flow, which is $2,000. Oh my goodness, look how easy this is. I just copy and paste, and then bam. Now, since this is a final loan, right, or a final credit card that I'm paying off, or the debt that I'm paying off, this goes to zero. Okay, so now let's go ahead and figure out how long it took me to pay off 25 grand in debt. And so, how long did it take to pay 25 grand in debt? It took us about 15 months, right? 15 months. So let's just kind of write our results, right? So we'll just put results right here. 15 months to pay 25K. That's not bad. I mean, to be honest, I paid $58,000 of mortgage. So again, pay off your debts. The more debts you pay off, the more cash flow you get, right? And also, if you can, learn how to make more money, more income, and decrease your expenses if you really want to pay off debt quickly, right? And then you'll get to a certain point where you're comfortable, have no debt, and then you can spend your money on whatever you want. But again, the point of this video is whether I get paid weekly, bi-weekly, monthly, it doesn't matter. I can even do it every 3 months. right? I could just, if I dump 3 months of worth of a paycheck into a line of credit, and let's say I borrow $100,000, okay, I need to make the payment. All right, well, just borrow the money from the line of credit and then make the minimum monthly payment, right? So uh, look how easy that was. Again, the strategy is the same regardless of what we did, right? So that's the whole point of this video. Don't think too much. The process is you dump your entire paycheck, whether you get paid once a month, twice a month, 3 times or 4 times a month, into that line of credit, which will satisfy the minimum monthly payment and lower the average daily balance. And then we're going to use our cash flow to pay this sucker off to go to zero, like we did right here. And how easy was that? I mean, did I really have to think? Probably not. And some of you think way too much about this, right? Or way too much, as in like we're overcomplicating it. Don't overcomplicate it. This is really easy. All right, so this is Korean Atlanta Mentorship. If you're interested in joining our group, go ahead and click the Google form link below. We learn about financial literacy, just a little bit more than velocity banking. We also learn about real estate investing, right? We want to be not only do we want to pay off debt, but we want to learn how to create wealth. All right. So have a great day, everybody, and we will speak next time.